So this is the super fun exercise that I like to have you guys do when we go through assertions in class. So I'm going to walk you through what I want you to do with number one. So for each of these sort of represents a potential error that the client has made. And for each of them, I would like you to go through and list which account balances are essentially affected and misstated, and which assertions are violated for those accounts. So I did the first one for you. Okay, so it's sales shipped FOB destination are actually recorded when shipped, right? So essentially the company recorded this as if it was an FOB shipping point sale, but some of the goods are still in transit at the balance sheet date. So we know this is no good, right? They kind of recorded the sale early. So let's look at which accounts are affected and which assertions are violated. Okay, so in terms of which accounts are affected, the easiest way, in my opinion, to figure this out is to write out the journal entry that the client would have made. And sometimes it's a journal entry that they should have made, but didn't. But in this case, it's one that they did make that they shouldn't have. So in this case, the client made this journal entry, but they shouldn't have made it. So because they made this journal entry they shouldn't have, revenues or sales wind up being too high as of the end of the fiscal year. So they essentially recorded a sale that did not exist as of the end of the fiscal year. So this is a violation of occurrence. You could also say for revenues, it's a violation of cutoff. For AR, it is also going to be overstated, right? Because they debited AR when they shouldn't have. So there is now an amount recorded in AR, which technically should not be there at the end of the year. So AR is also violating existence. So COGS, cost of goods sold, is also going to be too high, right? They debited it and they shouldn't have. So once again, occurrence is violated here. Also, cutoff is violated. And inventory is our one account that is actually winds up being understated. So inventory is kind of the standout here because it winds up being too low because they credited it and they shouldn't have. So inventory has completeness violated in this case. Oh, I see. And I wrote the cutoff is violated for revenue and COGS down here. Okay. All right. So that is essentially the first one here. What I recommend you do is you pause this recording and go do 2 through 8 yourselves. For some of these, you might have to refresh your memory about, which accounts might be involved for things like repairs, costs for PP&E, or for which accounts would be involved for litigation. Feel free to kind of Google and refresh your memory. So hopefully you're back after having paused the recording and you've done all these exercises. So this is kind of a overview slide for us, right? So assertions are a really helpful conceptual tool for the auditor because, like I said earlier, they help us essentially make sure all our bases are covered, right? Because when I go through and do all my procedures over an account like cash, AR, inventory, I make sure I have at least one procedure related to each of these assertions. Right? And this kind of helps me make sure that I've covered all my bases and I'm not forgetting anything. I'm not leaving anything out. So it helps me keep my detection risk at an appropriate level. So this is a final example of those main 4 balance sheet assertions for AR. Okay, so it kind of lists all the assertions, and then it's saying, okay, these are our possible misstatements for AR, right? So for example, for existence, really the risk is a fictitious customer, right? So you have a recorded balance in accounts receivable, right? A customer recorded that doesn't actually exist. And the audit procedure you would do to test that would be to confirm AR, right? And we sort of talked about this procedure before. This is when the auditor sends out, they take the AR listing, right? So again, we're going from the financial records. We take the AR listing and we send out letters to specific customers and we ask them to validate that their balance is correct as of the balance sheet date. For rights and obligations, the risk is that receivables could have been sold or factored. It's pretty rare that companies could sell off their accounts receivable balance to another company. Usually it would only happen if a company was in really dire straits, they're approaching bankruptcy, and they're in desperate need of cash, right? Because generally you can't sell off your receivables for all that they're worth, right? You have to sell them off pretty discounted for something like maybe 90 cents on the dollar or something. So procedures you could do there. We can do inquiry. We can ask management if they've sold off their receivables. Other things you can do is you can look for large, unusual cash receipts. I believe there are only a few companies that buy receivables from other companies. So it's not the largest industry. So you can look for kind of big, unusual cash receipts from these very few parties that are known to purchase receivables. All right, completeness. So our risk here, remember, is kind of the opposite of existence. Risk here is understatement. It's the risk that there are customer accounts that do exist, but they have not been reported, right? They aren't reflected in the accounting records. In this case, we usually do a account reconciliation of the accounts receivable balance. And basically the idea here is we compare sort of the general ledger totals of AR to all the individual subledger totals. Usually the point of this is to help us make sure we have the necessary accounts receivable detail. So according to their overall balance sheet, maybe it says they have 10 million in accounts receivable, but they've given us a detail that only totals to 8 million, right? And so we would kind of be trying to agree these two totals, and we'd say, all right, there's a $2 million difference. Where is this $2 million? And they might say, oh, that's actually our Canadian accounts receivable, right? And they're on a separate GL system, right? A separate subsystem. So they have to be added in separately. So that's what this procedure is referring to. It's kind of this idea that we're comparing totals from different sources to make sure essentially that we have all the details. For valuation allocation, the risk there with AR, of course, is that they could have receivables that aren't collectible that have been recorded at their full amount. And so the procedure there is all about testing the adequacy of allowance for doubtful accounts. And we'll be looking at things like historically, what has been the adequacy of allowance for doubtful accounts, historically, what is the rate at which they get paid back, what is the historical write-off rate, things like that. I have one little multiple choice question for you to read through. So I'll give you a second to read it through. And I give you this hint, which is, okay, it says we're testing for existence. We're testing existence for an asset, right? So think about this example here. We talked about testing accounts receivable by sending out accounts receivable confirmations. You could also think about my example earlier, right? I'm testing the inventory records by going and counting items, right? I have a record here, and then I'm going and finding that item in real life, right? And I said finding the item in real life was kind of like
finding a supporting document.
Hopefully you got answer C, which is you're going from accounting records where items are actually recorded out to supporting documents. If you said going from supporting documents to accounting records, that is a description of a test of completeness. So this is me going from my inventory items out in the warehouse and then trying to work backwards into the accounting records versus going from my inventory listing out to my items, going from my AR listing out to the confirmations. The reason why A and B don't work if you pick them is, well, there's two things wrong with these answers. So one is the word financial statements. Financial statements are way too aggregated. They're a very aggregated level, so you can't really test from them, right? The financial statements are typically one balance, right? In the financial statements, all I can see is total inventory. So financial statements have total inventory. In the accounting records, I can actually see a full-on detailed inventory listing like I was showing you. So that's the difference there, is level of aggregation. The other problem with these answers is they're saying you would go to the potentially unrecorded items or from the potentially unrecorded items. It's almost like they're assuming you have some kind of omniscient knowledge of which items are potentially unrecorded. So that's another reason why these answer choices are problematic. Like, if I knew what the unrecorded items were, why would I even need to test in the first place, right? So that's the other problem there. All right, so your answer was C.